Hello and welcome to Donation Investment. This analysis is for C on the New York Stock Exchange as of 16th of August 2026 with a share price of $121. The full report is on donation.ca. Clean forward PE of 50.7x is 2.25x the warranted 22.5x, while diluted earnings per share grew 1.4% on revenue, up 48.1%. The rule that fires is do not buy trigger 2, the absolute valuation arm. On the clean basis the framework requires, C trades at 50.7 times forward earnings against a warranted 22.5, a ratio of 2.25, where the trigger's limb sits at 2. The trigger carries a growth exception, and it does not hold here because the growth is not reaching the earnings line, the multiple prices. Note what most of the move was not. Only about 0.13 of the rise from 1.42 came from the higher share price. The rest is corrected method. The multiple is now the clean forward figure of 50.7 times, not the reported 43.8. And the conclusion does not depend on this report's bespoke guardrail, on the framework's own published Consumer Discretionary line of 24 times. The ratio is still 2.11, still above the trigger's limb. The second quarter, filed on the 11th of August, was a genuine beat. Revenue rose 48.1% year-on-year to $7.79 billion. But over the same quarter, diluted earnings per share grew 1.4%. Adjusted profit before interest, tax and depreciation grew 10.6%, and all three segment margins compressed. The quarter before that, per share earnings grew 6.3%. So the deceleration is a sequence, not a single print, and part of it is mechanical. The diluted share count rose 10.5% year-on-year as the convertible notes entered it. Revenue growth is exceptional, proven, and durable. Revenue is not the stream of price-to-earnings multiple capitalizers. Read the central case carefully because it is not a bad outcome case. It assumes C executes, Shopee compounding merchandise value in the mid-20s with take rate still climbing and hitting its $1 billion milestone, Money's book growing toward $15 billion with bad loans near 1%, Garena growing bookings high single to low teens. On that path, per share earnings reach about $3.87, up 39%. And the total return is still about 5% because the multiple derates from 43.8 toward 33 on the way. 39% earnings growth, delivering a 5% return, is the argument of the whole report. Across all three scenarios, the probability weighted value is $122 against a price of $121.94. There is no edge. The case against this call is strong and worth stating loudly. Analysts raised their consensus target from 133.60 to 146.80 after the print, with zero rating changes in 30 days. So the street looked at the same quarter and became more positive, not less. The bull case is $168 plus 37.8%, and it needs only two things: the subsidy war cooling as TikTok Shop rationalizes spending, and Money's provisioning decelerating below book growth. Business quality still scores 74. Timing improved from 52 to 60 on the post-results breakout, and two of the three entry paths are mechanically open. The one that is shut is price against value, and that is the single path this signal turns on. If the market keeps paying above warranted value, and it has for years, a do not buy will look like a missed rally rather than avoided risk. We would rather be early and say so than pay 50 times earnings for 1.4% earnings growth. Now weigh the risk against the reward. The bull case is roughly 38% above today, the base case the most likely, about 5%, and the bear case a fall of about 31%. So you are risking about 31 to make 38. So, I'll call on C on the New York Stock Exchange. Do not buy on all three horizons. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donation Investment at donation.ca. The link to the full report is in the notes below. Have a great day.